Learning objective 3 is financial information sources, and this is useful later on when you're looking at your projects. We're going to look at IFRS, SEC, analysts, credit agencies, and data services. So starting with IFRS. So IFRS is International Financial Reporting Standards. We covered that earlier. And compared to GAAP. So there are differences, and I'll put them on one slide. They're much more technical than this would be, of course. The most visible difference is that the liquidity balance sheet is in reverse order of liquidity from the oldest to the one that's most current. So cash is not first. Second is income statement, is that IFRS requires 2 years of income statement disclosure. GAAP requires 3. I like 5, so neither one really satisfies me as an analyst, but that's just kind of the facts of the difference. The statement of cash flow is one of the biggest differences, is that in GAAP, we show interest expense revenue into operating expense as part of net income, whereas IFRS allows companies to choose between 2 ways of showing interest. One is part of operating expense, and the other is part of investing, right? You can see that there's a theoretical justification for both. So this is by illustration to show that there are fundamental differences between IFRS and GAAP. I will not, for purposes of our course, have you learn the detailed differences between IFRS and GAAP. I just need you to know what they are and that differences exist, and broadly that they are kind of core, non-trivial differences that are holding up the convergence of GAAP to IFRS. Additional sources. This is a short list, not the full list, of items that are required for disclosure on the 10K. I'm not going to go through every one of these right now on this video lecture. You could see it on your own. But the key pieces that you would see for our purposes is the MD&A, which we've seen before. And the other critical one is right here. It is the financial statements and supplementary data, right? So as far as the use for a project, these are the ones you concentrate on, MD&A and the financial statements themselves. The rest could have value, so I'm not saying don't read it, but there's some administrative or regulatory items there. So you could scan them to see what they are and see if there's anything relevant to your analysis. For Form 20F and 40F, these are items for companies that trade in the U.S. but that are not registered fully with the SEC. So those are Form 20 and 40. 8Ks, these are those unusual items that may occur that are material for people to know. And just a few of the examples are, if the company declares bankruptcy, that is something people ought to know. They shouldn't have to wait a year to know you declared bankruptcy. Next is if there's an exit from a line of business. So in the early example where we had 2 lines of business, one worth 50 million, one worth 20 or 10, and we're getting out of one, that's a material thing for people to know. A stockholder in the business may want to know that the board has made a decision to exit a line of business. So that's required when it occurs. Next is when there's a change in the CPAs. This is seen as suspicious. So when a company cannot quietly change their CPA when they have a disagreement. So they have to put a bright light on it. So they're not going to shop for audit opinions or just be forceful in kind of coercing the position of a CPA firm. So that's why this is there. Change in control, which means they sold the majority interest of a company to somebody else. A merger or an acquisition would be disclosed in this way. Departure of a key executive. If Elon Musk quit Tesla, that's something you'd want to know about. So that's an 8K item. And the other is articles of incorporation. So if you're changing the rules by which a company is run, shareholders deserve to know that too. So these particular items seem to be a random collection, which I guess there is some random collection of things that could happen, but they're required to be disclosed pretty much as they occur. You cannot wait a year to tell shareholders and outsiders about this. You have to tell them on a much more timely basis. This is an example of an analyst report. An analyst is a department in a major company that makes recommendations to its clients on what to do with the stock. So basically buy, sell, or hold. In this particular case, this is Credit Suisse, and their analysts are looking at Apple, and then they are talking about the financial and the stock valuation of Apple, and they will make a recommendation, and this will be distributed to the clients of Credit Suisse. These are very influential documents, and there are people that follow the analysts. There are analysts who follow the companies, and there are companies that follow what the analysts do, including Yahoo Finance. I'll show you these. Data services and credit. Credit analysis, I mentioned earlier. There are three major companies that do this: Standard & Poor's, Moody's, and Fitch's. Data services are people that have data that are searchable or are in reported form, and they again serve the investment public to help them make better decisions. So Reuters, Capital IQ, Bloomberg are all examples of data services that assist investors in making decisions. So end of Mod 2, we have financial statements, and we did a deeper dive into each of the four. We did some level of detail on what is current or non-current, and some of the more typical line items that you would find on the four statements. The Gaap principles that we looked at so far are accrual, which is recognize revenue when earned and expenses when incurred. Revenue recognition, which is one of the most abused areas. We'll talk more about this in a full chapter later on, but this shows how a company sets its accounting rules for when it can count revenue. Matching is when we have something like a sale, we must match the cost of goods sold to those. So in the example, we sold $1 million worth of product to Google. We had to match against it the $200,000 of costs of that item we sold to Google. Historical costs, this is the Gaap rule for, say, land. That was the example we used, where we record it and show it on our balance sheet at historical cost, even though it could be wildly different from market value. In IFRS versus Gaap, we saw just a few of the differences that still exist between US Gaap and IFRS. And we looked at a bunch of other sources of information that will be useful for you in your project or in your analysis of companies. And some come from required SEC reports like the 10K or the 8K or the 20 and 40 Fs. And then we have outside agencies that assist the investing public, like credit agencies or data services. So this is a very fully developed, fully mature segment of the economy, of the stock analysts and all the support structures that help people make prudent investment decisions. Okay. So final word I'd like to make is on your team project. So at the end of session 2, so not for this next meeting, but for the following meeting, I want your teams to think about who do you want to analyze. And the sooner you pick it, the sooner you can get started thinking about or actually doing the work. And think of it maybe from 2 or 3 different points of view. One is maybe the group has an idea of a dream employer they want to analyze. So if you want to work for Intel, right? Analyze Intel, and would help you know about Intel more. So when you're going to interview or reach out to Intel, you're knowledgeable. The second is your old company. Maybe you used to work for Microsoft and didn't understand how or how much money they made, so you might want to choose Microsoft. Or it's just a curiosity. You don't know anything about consumer product companies, so you want to look at Procter & Gamble. Or you don't know anything about biotech, and you want to look at Genentech, right? So it might be an industry or a curiosity. But I have no constraints on this, other than I don't want multiple teams on the same company. So I'll work out a mechanism, which I'll describe as a tiebreaker, to make sure you guys pick the right company. So I would suggest you think about companies and think of 3 that you like in rank order, and hopefully make it so that every team would be able to get one of at least their top 3 choices for a company. But for now, just start the dialogue of who would you like to spend time analyzing and presenting in front of class. All right? Thank you. That's it for the videos for session 1, and I'll see you in class next week. Bye-bye.